about this whole topic of primary product dependency and volatility of commodity prices. And it's the first two factors that affect development, which are worth putting into one sort of piece of quite developed analysis, as you'll see. So, firstly, what do we mean by PPD, or primary product dependency? Well, it's a reliance on some narrow range of products, usually commodities, oil, that sort of thing. And you can look at it in terms of percentages of employment, GDP, or exports. And here's two countries here, Cambodia, Bangladesh, worth studying, where this is Bangladesh's exports, and you can see knitted clothing and non-knitted clothing. The ready-made garment industry in Bangladesh is massive, nearly 85% there of exports, and this is Cambodia, when you get a very large amount of export earnings coming from these sorts of garment industries, including footwear and leather articles, etc. There is a little bit of other stuff going on, but those are the main ones that we're talking about in terms of, as I say, Cambodia there. Now, what's the problem with PPD? And I think this is the key issue that you need to consider. And the first thing really is that you've got to make sure that you stress this, that it's the volatility of prices, revenues, profits, export earnings, and hence the exchange rate, which is what we're going to go through. Now, you can't just say it's the prices are going up or down. You have to really stress that it's going up a lot, going down a lot when you get to this. Okay. The second thing, there's a Dutch disease, what we call a Dutch disease, when if you are reliant on a primary product like a commodity, and there's a great increase in demand, your exchange rate is going to go very strong, and that's going to have implications for the rest of the economy. And lastly, what we call the Prebisch-Singer problem, where the terms of trade are simply going to worsen over time. So it's a perfect way of setting out an essay, if you were asked to do an essay on this, in terms of three different points. So what's the reason for this volatility of prices? Well, the basic reason is that the PES for many commodities is inelastic, certainly in the short run. If you think of farmers, you think of mining companies, oil companies, the price can go up a lot, the demand can go up a lot, but they cannot simply respond very quickly and produce a lot more. And so in the short run, unless they've got levels of stock or spare capacity, something that you could have looked at last year when you were looking at reasons why prices are fluctuating in markets, you're basically saying that in the short run you've got inelastic supply, and also you have inelastic demand, price inelastic demand as well, mainly because they're staple products, low value, and really when the price of them goes down, for example, people don't suddenly rush out and go, oh great, I can buy lots more of these commodities. So you have inelastic supply and price inelastic demand. So if you have inelastic supply, then any shift here of the demand curve, up or down, is going to lead to a large and a volatile change in the price. Okay, same with inelastic demand. If you have price inelastic demand, changes in supply, and I've just drawn this for an agricultural market, where you have a good harvest and bad harvest sort of thing, the price is going to go up and down by huge amounts. So you've got to pick up that there's great volatility, not just the prices go up or down, there's a volatile price. Okay, now what's the consequences? Well, the first one is that in good harvests, if you're a farmer, prices are going to drop a lot, and so your revenue is going to fall. So that's slightly odd, because you'd think that if there's a good harvest, farmers are going to be happy, but in fact their revenue falls, and that's why we need to talk about buffer stocks as a way to help these farmers. Obviously in bad harvest, then prices rise a lot and your revenues rise, so it's a little bit perverse, that market, and we need to come back to that and look at the buffer stock schemes. But if you're just talking about commodities rather than farming products, then if there's a fall in the demand for your commodities, slowdown in world output, COVID, etc., prices are going to drop a lot, and so would your revenues. If the demand rises, prices rise significantly, and only might get a elastic supply in the longer run, but you're having this big significant change in the price. So the fact, and this is what you've got to get through to, prices, revenues and profits fluctuate a lot. That means there's uncertainty in that industry, and if there's uncertainty, it's going to kill investment. Investment is based on certainty of prices in the future, profits in the future, etc., and your revenues, because when you invest in something, you're going to have to pay for that for a long period of time. So it's the key thing you've got to get to, that the volatility of prices causes investment problems. And then you can move on to, it also leads to uncertainty about export revenues, okay, because these tend to be exported, and in addition government revenues. So governments will tax profits of firms and farmers, and also very often governments are in joint ventures with commodity oil exporters and copper exporters, for example, and so there's going to be a great volatility, not just of prices and profits, of revenues, but of export earnings and government revenue earnings as well. So those are the consequences. So let's summarize that. The volatility of prices are caused by small changes in demand, leading to large impacts: firms, government, tax revenue, export revenue. The volatility leads to less certainty, lower investment, a lack of investment both internally and from overseas, okay, and you can use the multiplier effect there as well. And that investment, inward investment coming into your country, that might be put off if you've got this uncertainty, and so there's less of this funding of your current account deficit, if you like, okay, the surplus on the financial account. And so you've got to see that that is going to affect the level of economic growth that goes on in the economy. But in addition, countries that have got their PPD, as I said just now, you're going to be talking in a minute about the Dutch disease. If their currency is strong, let's say oil exporters, and the price of oil goes up, that strengthens their currency, and when the demand is weak, it lowers their currency, and so it's more expensive for them with this lower currency to buy imports, but we'll talk about that in a minute. In terms of trade ratio, over time is going to fall. This is called the Prebisch-Singer hypothesis, and it means that you've got to export more of your products to buy imports that are needed for your living standards. And in addition to that, demand for your commodities fall, your government revenue is going to fall by a large amount, tax receipts are going to fall, less can be spent on merit goods that benefit development. HDI, remember, Human Development Index, includes an element of health and of education, but you can go on to less housing, less infrastructure, less sanitation, less running water, so less human development going on in your country. So pretty comprehensive list, if you like, of the negative impacts, okay. And in addition to that, your foreign currency reserves are going to fall, so the amount that you're earning on your exports are going to fall, which reduces that country's ability to buy essential goods and services. So that's another important negative impact of having primary product dependency. But is there any positive impact? Well, yes, there are countries where it works out well, and we're going to see one of these. Australia, Ghana, Botswana, Chile, Norway, countries, the oil states. These countries can tend to use their reserves of commodities, and in good times they deal well with it. That's the key thing, as you'll see in the case of Australia at the end. And also it means that you can't argue that because they've got a large resource of natural resources that they shouldn't be exploiting those, because that's the whole purpose behind comparative advantage. So they're using their comparative advantage. When the demand is strong, they can have large amounts of export earnings. Firms, governments benefit greatly, but the key to keep coming back to is it depends what happens in those times. It depends what they do in those times when their prices and demand is strong for those currencies, for those commodities. So what are they going to do? What are the government going to do with that? Okay, so that's an important thing. If you've got the high export earnings, you can buy these life-sustaining imports. You can buy machinery. You can buy different types of capital investment in order to take your country away from being dependent on a single commodity. And it's tempting to stay where it is. That's called the resource curse and low-hanging fruit. But better countries will develop and industrialize their countries. And, you know, when the revenue is high, governments can use that, call it a fiscal dividend, and they can, you know, build hospitals and education and infrastructure. So having, a primary product dependency isn't always a bad thing. It really depends on what governments do when the price has gone high in the market. Okay, and also the availability of those resources is going to attract inward investment. You often need to have foreign companies coming in to develop these resources. Okay, so let's finish off by looking at two of these particular problems in a bit more detail. The Dutch disease, and it has a negative impact on the economy. It came from Holland. Anything that gives a sharp inflow of foreign currency. So they found a large amount of oil. The currency inflows led to the currency, that was the guilder in those days, appreciating, rising in value. And then it makes other products, so other manufacturing sector in Holland actually suffered greatly at this time, and often those companies would leave Holland, so they deindustrialized. Okay, the Dutch economy. This is what the Economist coined it back in 1977. Okay, that they called it, we noticed a contrast between external health and then the internal ailments, as it were, and investment was falling. Venezuela, another country which has a huge reserve of oil. Okay, Saudi Arabia is second, so Venezuela's got a huge amount of oil, but they really, it says down here, look, they really did not invest it properly. They didn't invest in health, education, infrastructure, modernization, and savings. What they did is they spent on consumption and supporting another revolution in another country, but they emerged then more vulnerable at the end. But Australia is blessed with the stuff. That's what this article was saying. So for more than a quarter of a century, it's not had a recession, largely due to the Chinese demand for raw materials. So Australia is a country which has quite a lot of reserves of commodities, etc. But they've done well by selling those in the market to China that needed it when they were expanding as well. So there's always examples of good things happening, and here's one which is right up to date. This is Ghana. In very recent times, Ghana has discovered a lot of oil, and basically what the officials did is they prevented the government from what they call front-loading the revenue by selling it in the futures market. Now, what that means is that very often what governments do is when there's been this great discovery of oil or any other commodity, they agree to sell it so that they get the money up front now, and then they'll deliver the oil maybe in a year or 2 years' time. So they're using that money up front, as it were, rather than waiting for the discovery to really be fulfilled in that sense. And they have modelled themselves on the Norwegian. This is the sovereign wealth funds of Norway and Saudi, etc. And it stipulates that 30% of petroleum revenue gets paid into a stabilisation fund, so very similar to a sovereign wealth fund. Okay, Here it says that this is all from an FT article recently, or it says that Ghana has not succumbed to the Dutch disease, and in fact quite the reverse. So it is not finding that its currency is rising. It was concerned that it might hit parity with the dollar, and now the Ghanaian currency, the cedi, is trading at 5 to the dollar, which is 1 cedi is 0.2 of a dollar, 20 cents. So, it's still a low valued currency. It says here that the gas that is produced by finding this oil in Ghana is in ensuring that Ghana has a stable supply of electricity, and so that's very important as well. Okay, and also they're using universities which didn't offer courses in petroleum before. They're now starting to offer courses and getting Ghanaian engineers coming through. So Ghana is a really good example to say that the resource curse, the Dutch disease, etc., doesn't always have to end up as a drawback for countries. Last thing to talk about is the Singer-Prebisch-Singer hypothesis. This was put forward some time ago now, but all it's saying is this, that the demand, as world incomes rise, the demand for commodities is going to be positive. It has an IED which is positive, but very small. So as incomes rise, the demand for commodities is going to rise by less than that percentage change in income. So it's inelastic IED. So the demand curve is going to move to the right over time, but the price of commodities in markets is not going to rise as much as the price of manufactured goods. So as incomes rise, we tend to want lots more manufactured goods, so IED is much higher for manufactured goods, so the price of manufactured goods is going to rise considerably. Okay, so commodities is going to rise by a small amount, and the price of manufacturers by a large amount. Well, how does that affect things? So you need to now consider the terms of trade, which you should have done by now, and the terms of trade index is the index of our export prices over the index of our import prices. So if you are a country which is suffering this primary product dependency, then the export prices of your commodities gone up by a very small amount, but the import prices of all those manufactured goods is going to go up by a larger amount. So it's going to cause a decline in the terms of trade index, which simply means that you've now got to start exporting more of your commodities in order to buy your imports of manufactured goods, and that could also be essential capital goods as well in the market. And so a fall in the terms of trade ratio is going to reduce your standard of living. Okay, so that's important. And Paul Collier, an economist of great regard, talks about the resource curse, and he talks about it in terms of its primary product dependency. Countries that are blessed with the natural resources struggle to make best use of them. Venezuela, Angola, Nigeria. Whereas other countries, Japan, Switzerland, very few natural resources, but they're ending up much higher levels of development. And he's put a lot of work into this, and he looks at things like, there's often civil wars over the resources, and he's referring in Angola to UNITA, which is the rebel organisation, if you like, and what they're doing and how they're battling with the government. So UNITA funds its war from diamond mines in Angola. The government are funding it from gold and timber and animals and diamonds. So there's going to be some civil problems and war over the ownership. He calls it also the problem of low-hanging fruit, in the sense that if it's very easy to earn your money just by, mining and exporting your commodities, then there's going to be a lack of investment in other industries. He mentions again the problem of Dutch disease and Prebisch-Singer, and that some of those resources are in the public sector, because often, you have to question who owns the mine. So if they find oil, or if they find cobalt or lithium, which is a big one at the moment, who owns that? And often it's the government that say, well, we own that, and they start to sell it off to multinational corporations. So that can also lead to corruption. So that's a problem of what they call the resource curse, although nicely this comes from an article about the Australian economy, the key conclusion that the resource curse is a misnomer, and it's rather than being cursed, nations have to a large extent the capacity to control the effects of having the resources. It's not a curse, they say, but it's a resource temptation that can result in a curse. So the lesson is in Australia, we're not automatically immune, they were saying, from the resource curse. Constant attention is needed to ensuring that we maintain institutional framework. It's about the government. What are they going to do about it to ensure continued benefits without the detriments that having resources can bring? So it's really quite important that you finish a strong conclusion that it doesn't have to be a problem to have PPD, but it does depend on what you do in good times or what government policies, strong government policies, are put into place to make sure that the temptation doesn't lead to a curse. And so the theories, finally, that you've got to go back and look at and use are: there's a problem of volatility, less investment, the Dutch disease, high exchange rate, so quantity of other exports falling, and all the problems that brings, the Prebisch-Singer hypothesis, terms of trade worsening, and then this problem of low-hanging fruit. So quite a lot to get through, but really worthwhile thinking about it in that sense there, that you can really talk about it in terms of the Dutch disease, the Prebisch-Singer, and the resource curse as well. So hopefully that gives you a good idea of how to structure an essay in the exam.